Hi, I'm Brooks Hutchinson, a Senior Vice President here at First Financial Wealth, and today I'm joined with
Chris Montoya, Executive Vice President of Investments at First Financial Wealth Management.
So today's point is, we've been talking about a lot of your market updates, Chris, and I think one of the things a lot of people want to hear about is adding a little bit more meat and potatoes on what that means for them individually to their portfolios.
Sure.
Without diving into everybody's individual needs, one of the things that we want to talk about is with the success of the markets that we've had in 23, 24, 25, and even now year to date 2026, there's going to be a lot of what we like to call portfolio drifts or misalignment of what we've set as an investment objective for them and what it's actually at now. So can you kind of go elaborate a little bit on what portfolio drift really means, why it's important, and why it needs to be monitored?
Absolutely. What we tend to find is, as you mentioned, Brooks, that when the market gets on one of these extended periods where one particular area of the market does significantly better than the other, what you begin to have is that area that is doing best is growing larger and larger in size. And it's becoming more and more of a determining factor on your future success and future returns. And so when you think about when you sit down with your clients and you come up with, what is the best mixture of assets for them to meet their financial goals long term, you have that number in mind. And as every day that the market does something different, you're starting to stray away from that number. And so, as you mentioned, a market that's 3.5 years into a very strong rally where returns have been double digits in stocks, there is no way that fixed income could, compete with that type of return. So what you've seen is your stock allocation has probably gone far off from the number that you established when you met with that client. And in the same tune, the fixed income has now become a lesser amount than the target you had established. And so during that period of time, I think what's important is that, you have a mechanism in which you rebalance the account. And by rebalancing the account, you're doing nothing more than just saying, hey, stocks have been extremely successful. We know this doesn't last forever. Trees don't grow to the sky. So let's take some chips off the table, bring it back down to the target. And while we're going to do with the proceeds is that we're going to reinvest it into the fixed income that has now become too light compared to what we initially discussed when determining the client's goals. So that's pretty much what rebalancing is about. You can do it on broad things like stocks versus bonds. One of the things I think that makes us unique at First Financial is that we do it both at the individual sector level and even at the individual position level itself. So for example, let's say the last 3.5 years, we all know that AI has been an extremely important factor in determining success of portfolios. So all the companies that are attached to that, they've done fantastic. They are no longer the same percentage in your portfolio as what they needed to be when we first talked about meeting a client's financial goals. So the same thing there, just like you want to bring your stocks down, you bring those particular names down. And that's both at the individual stock level, but that also adjusts, how much you have in technology or how much you have in some of these industrial companies that are building data centers and things of that nature.
Yeah, and that raises a good point because people would think, oh, we're in this equity mix of 60-40. Now we're in an equity mix of 65-35 because of how well the equity markets have gone. I need to go sell 5% of my equities to move over to fixed income and get it more diversified. But it's the 5% that you're selling that's very key because not all those sectors have been performing at the same rate. AI is outperforming healthcare or financials. And then if you even go into another perspective of large cap versus mid cap versus small cap, or even to take it a step further, international and emerging markets, it's a perfect mix that you start out with, and keeping those ingredients in line for your overall recipe is very, very important. Because one of the analogies that I give to clients all the time is if you're baking a cake, you set the precedent of what the ingredients are going to be, because not so much that you want to change a little bit, add a little bit more sugar here or add a little more icing at the end, but too many eggs, too much flour, you're already starting off with a bad recipe, and it's not going to taste good. It's not going to look right. So you start to get a little too many eggs. You got to dial it back a little bit.
Exactly. Perfect.
It's all about sectors and all about knowing which part of the ingredients need to be dialed back, not just, hey, we're moving equities down.
Oh yeah, absolutely. When we receive instructions in the investment area of needing to rebalance for a client, It is not just across the board sell 5% down on all the equity positions. As you discussed, we're going to target the ones in which they are now representing a portion of the client's portfolio that isn't what was identified, in the beginning to get them to their long-term goals. And what I think that really helps with a lot of this, Brooks, is that when you think about it, it's always fun to have this come up as a situation because markets have been good. We know that there are times where there are bumps in the road in the economy and the markets don't behave the way that we would like them to. And so rebalancing, what I always tell people is at the moment in which you feel really good about what you're seeing in your portfolio, that's probably the moment in which you should be rebalancing. And human nature is hey, if I got a good thing going, let it ride.
Yeah.
And what I love about the rebalancing discipline is that it takes the emotion out. It says we identified at the very beginning, what do you need to have your portfolio look like in order to meet these goals that you've identified? And so, yes, every day that goes by, people kind of forget those conversations. They get really excited about, what's doing well in their portfolio. It's just human nature. That happens to all of us, including me, who does this every day. And so that's just
human nature.
It is. It is. So, when you have a winner, you want it to stretch its legs. And for us, having somewhere defined, yes, we understand the markets move every day. So there's going to be, some moves here and there on one side or the other of the number that we've identified. But if it gets too far, it is prudent to rebalance. And so, to me, it takes the emotion out. But I think secondarily, what a client should feel really good about, Brooks, is that, this rebalancing happens sometimes even when they don't notice it. And what I mean by that is, we are an actively managed shop. When we buy each of these stocks or each of these individual bonds, we don't buy and hold. I always tell clients this is a buy and homework shop, meaning that we bought it because it meets the need that was identified for you to reach your financial goals. But every day that goes by, that may no longer meet your goals, or it's no longer in the proportion that it needs to be. And so what we do a lot of times is what we call block trades, saying we've had a name that has gone successful and is now dominating performance and puts the client at risk long term. Without the client really even knowing it, we will trim that position and we will redeploy the proceeds into another area of the portfolio as you've identified that maybe, is just as successful as this stuff that's rallying, but that's not where the market's frame of mind is at that time. So they're kind of the ignored areas of the market. And so we do that for the client. And so to me, the way I view it is when those tough times come up, it's human nature to say, oh, things aren't good anymore. Hey, Brooks, should we move to cash? Or, hey, should we sell out of our entire portfolio, ride this thing out, and then get in at a later date? And that in of itself has its own sets of dangers because, returns are not uniform, meaning that you can never predict when it's the best day in the market going to be, nor when is the worst day in the market going to be. And so the way our process is established is for you and your clients, you've drawn the line in the sand that if it gets to this point, we're taking emotion out, we're going to dial it back. Same thing on the individual stocks and bonds. When we see one name getting too far ahead of itself, we're going to, reel it back in, and get the proportions where they need to be. And then lastly, with it being an actively managed portfolio, both your equity and fixed income teams are also looking at the economy and making projections about what we think is going to happen next. And so when we think that, hey, there's a bump in the road likely, we're already dialing down the risk just in the individual name. So there's really, when you put it all together, 3 risk mitigating buffers that have already been put into the portfolio that really doesn't, need for the client to take an action as bold as go to cash or do something like that. And again, it's all just takes emotion out and it leads to positive long-term results.
Yeah, one of the things I'm always telling my clients as well is, if we've set your precedent as 70-30 and now you're 74, 26
Yep.
or something like that. 2 to 3% over an investment objective is nothing to raise your eyebrows.
Exactly.
When you get to the 6, 7, 8, 9, even 10% over those investment objectives, and you're saying, hey, this economy is just going to keep on rolling like it's rolling, you're going to keep straying further and further and further from that investment objective. And it's okay to ride it out if that's what you're wanting to do. But what you've got to realize is if there is that correction or if there is that turn in the market, we've now subjected 8 to 10 to 12% more of your portfolio to that correction than you were comfortable with to begin with.
Exactly.
So that's a due diligence part that we have to always keep in monitoring. And the other thing that keeps a lot of people from wanting to do these rebalances is the side effect of paying the taxes in our non-qualified accounts.
Absolutely.
So we're always having to talk to people and say, okay, we're over allocated to this certain asset class. We need to go shave it down 6%. But in the resulting of that 6% shave down, you're going to owe X amount of taxes. And they say, no. You're telling me that you're going to go sell something, recognize capital gains on it, and I'm going to pay taxes on something you're not sending me cash for? And you're like, yes. So can you a little bit, I don't like to use the word that's an insurance move, but do you have a better way to describe why it's justifiably it's a good option to pay the taxes even though we're not getting the proceeds?
Oh, absolutely. And I am guilty of this personally, Brooks, where just like our clients, even in my own personal portfolio, what's right for my family, a lot of times when I sit there and say, hey, I'm supposed to be taking the emotions out, you'd think that it would be like clockwork considering I do this for a living, and it's not. You see what the tax bill is and you think, do I really need to be doing this? And I would say the answer is yes. And it's yes because of two reasons. Number one is just nothing more than a mathematical thing. And what I mean by that is if you take what your gain is and you look at what the tax implication amount is, you can then take what that tax liability is, divide it by the number of shares. And what that does is it then tells you if this stock drops this amount, then it's actually better to pay the tax than have held it, because you would actually be poorer than if you would have paid the tax. And so what you begin to find is, and I have to train myself, like I said, personally to do this, is that a lot of times, yes, it doesn't feel good to pay the tax, but when you do that calculation, you begin to realize that that amount that the stock would drop, in which it's actually better to pay the tax than to have held it because you would be poorer, is a very high likelihood.
Yeah.
And so it makes sense to do that. Secondarily, I think you really hit it on the head, which is always, if I'm going to pay the tax and we're going to generate these proceeds, then what? What are we going to put it in? And many times, what happens is that you're taking risk off the table. And the way that we manage money at First Financial, I think, is very unique from the aspect of our stock and bond portfolios are purposefully built to serve as natural hedges to one another. And what I mean by that is we go in with the mindset of where is the world today, where is it going, and what names would be successful in that environment. And therefore, we want to own those names because the longer you hold them, your tax rate goes from short term to long term, which is less of a liability. But then secondarily, if we're focusing on the growth of the portfolio, then when times get rocky, people begin to sell their stocks. Well, it's just like, again, it's human nature. When you get nervous, what do? You want to do the safest thing possible. So the way we build our fixed income portfolios is we buy the highest credit quality, because that is where people run when they get scared. And so what you end up happening is that you harvested your gain. Yes, you paid Uncle Sam their share, but then you have now changed the risk complexion of your portfolio. So yes, you still own stocks and they will come down. But those bonds that you now bought with the proceeds, plus the other bonds that were in your portfolio that were identified at the very beginning, those rally in value, and it begins to soak up a lot of the losses that the stocks are generating. And so for us, it is kind of like an insurance move. But yeah, we view it from kind of a two-view angle. Number one, mathematical, and then number two, just how we invest money in general.
I've never liked to use the insurance term or the gambling term. Those are two areas I'm like, ooh, got to really be careful how to present.
I can understand.
But it's a very important concept for people to understand in everyday life of what they're doing.
Absolutely.
Everyone thinks that there's always just one option when it comes to this stuff. And what we have to do is their financial advisors come in and present their options for them.
Exactly.
Because, let's say that client is charitable in nature.
Yep.
Right. and they're over allocated in a stock that they're never going to be able to get out of, because even though they're over allocated to equities, they don't want to pay the taxes on it because the basis is so low. Well, if they're charitable in nature, there's opportunities for us to be charitable by giving those shares out stock, not allowing them to pay that tax. And what did we do in the process? We brought their equities back down, all while saving them not having to take any taxes. Had that person not done that, sold those equities to cash, then taken that cash and been charitable, well, now they've been charitable, but they're also paying the tax to Uncle Sam.
Oh, yeah.
The other part that we always look at is, if they've got actual qualified accounts that are a little bit more conservative than the account that we're trying to rebalance back to the present position, is doing swaps.
Yep.
Basically saying, hey, let's go rebalance something that's not going to trigger a capital gain instead of rebalancing the thing that's going to give us a taxable gain. You're still keeping that account heavy in equities, but what you're doing is you're offsetting your whole portfolio by another account that's not going to trigger those gains.
Exactly.
My point being, there's many different ways to look at it from that standpoint, but my point being is there's plenty of options for us to look at before we just say, oh, we're just going to go trigger this. You're going to have to write a check, and it is what it is.
Oh, yeah. And I think that's perfectly said, Brooks, because when you really think about it, in as much as people think that what you and I do for a living is the equivalent of rocket science, I assure you it's not. And the reason I say that is because that there's really only a handful of factors that increase your odds significantly that you are going to be able to obtain the financial results you need to meet your goals and your desires. And the first one is, asset allocation. What mixture do you need of stocks and bonds, and then what types of stocks and bonds? That's identified at the very beginning by, advisors like yourself that are trained to know kind of how to move those two variables together. The second area that really makes a big deal after that is then saying, okay, then when I need to make rebalances to this overall allocation, where do they need to happen from for a most tax-friendly manner?
The disciplined investor.
The disciplined investor. So the fact that we take multi-year views on our investments already lowers tax obligation because it's long-term in nature, mixed with the asset location of which accounts make the best sense to rebalance from, is already saving the client money on what they have to give away to Uncle Sam. And then number three, I think the other thing that people need to keep in mind is that what do you pay as a service to in order to get this done? And so when you think about those three variables, do I have the right mix? Do I have an advisor that understands how to get this money and move my portfolio around for all different environments to meet my needs, mixed with what do I have to pay them to do it? These are three things that First Financial does very, very well and has been doing it for nearly 100 years.
Yeah, and I would agree that is a huge part of having an advisor, is because we can take the emotion out of it. I've always said I can manage someone else's money a heck of a lot better than I could advise on my own, because I don't have that emotional tie to it.
Exactly.
And so from a mathematical standpoint, I'm like, this makes the most sense in the world. But on the other side of the table, they're saying, I don't care how much sense it makes in the world, it still hurts.
Exactly.
Now, the good news is you're making a lot of money. The bad news is you're making a lot of money.
Yeah.
But we have to be able to hedge that, because I don't want you coming back to me in 2 months when the market corrects and you're like, why didn't we do this rebalance?
Oh, yeah. Well, there's a couple sayings that always come to mind, Brooks, when I think about those situations about rebalancing, paying taxes, all that kind of stuff. And they're just old rules of thumb that we tend to joke about in the investment department, because even though they've been around for decades, they still apply. And that is, number one, that, no one has ever gone broke taking a profit. So if you really worry about what is the biggest risk that I have with my money, it's that we mess up and it's all gone, or number two, that we don't take the measures needed to keep you on track and you end up taking too much of your money and therefore run out. So no one going broke taking a profit is something that sounds funny, but mathematically has proven to be a great recipe builder. I think the second one is always Warren Buffett's adage of, be greedy when others are fearful and be fearful when others are greedy. That really applies because, again, human nature is that Brooks, you're saying I need to, rebalance my account. We're going to be selling stocks. These things are awesome. I mean, for 3.5 years, all I do is I open my statement or I get on the app and the number is bigger. This is awesome. Why don't you just let it ride? And it's because guess what? You've now gotten caught up into what everybody else is seeing. And so everybody's getting greedy. So now is the time to start being fearful. And that's where rebalancing really takes that emotion out.
Balancing that greed is one of the harder parts of the job.
Absolutely.
Because you have to say, why do we need to keep earning 14% with 3x the risk when your plan worked at 8 or 9?
Yeah.
And we're not saying that we're not going to continue getting you great returns in the double digits. It's just not sustainable.
Oh, absolutely. And the other thing that I always tell people is that if you really want to know how to make money, having a money manager that can make you a lot in the good times, yeah, that's important. You want to know what's more important? One that doesn't dig deep holes. And so the rebalancing discipline that you've mentioned, where it takes emotion out, because we're getting you back on target that we identified day one. But then secondarily, from a stock investor myself, when I'm building these portfolios, we are watching these names every single day and taking action as we feel the need is there. And part of the reason for that is that we begin to say, hey, given the way that this stock behaves in good times and in bad, let's say it loses, 50% of its value. Okay, you lost half of the value in that stock because you didn't take action, which is going to be far in excess of what it would be if you would have paid the tax. But more importantly, we can then go mathematically calculate that says, given the way this stock behaves, how long does it take for you to get back to the amount of money you have in this name that you have today? And a lot of times what you begin to find is that the best course of action is to just take these unemotional risk mitigating steps along the way. It just saves so much, not only headache and emotional capital, but more importantly, over time, it really makes a bigger difference than most people can really imagine.
And I would also caution, as just a couple other caveats, is, just because we're sitting here talking about rebalancing when you're getting out of your investment tolerance doesn't mean, oh, crud, I'm 2% over, I need to go rebalance. And then 6 months later, you're 2% over, oh, I got to go rebalance again. Over trading and things like that erode returns as well. So don't ever take this conversation, audience, as something where like, oh, crud, I did a rebalance 6 months ago, but now I'm already 1.5% over. I need to go tell them to trade it again. No, these are for very extreme circumstances where we've had the market that we've had over the last few years, and it's become a lot more volatile. And people are starting to ask questions. They're starting to put up the yellow flags of, hey, is now the time? And I'd say 100% yes, now is the time.
Now's the time. And what I would say, Brooks, also to that is some other unique stuff that comes up along the way is that, now is the time because from a market's perspective, we are actually seeing something right now that we haven't seen in close to 20 years. And that is when your stocks are doing fantastic, think about the last 20 years in the U.S. economy. That meant selling stocks that were making you money and reinvesting into bonds that were only making a couple of percent. And what I told people is I could understand how that could be a more head-scratching decision because it's not like the bonds that you were buying had a lot of income to them. So there wasn't a lot of meat on the bones to soak up losses. Rates right now are the highest they've been since 2007. So you've got to go back almost 20 years to find rates this good. And what I like about it is that, again, from bonds, it's nothing more than a mathematical computation. The higher your interest rate is that you can get on a very high quality safe bond that people will go to when they have fear, then there's more meat on the bones. And what I mean by that is there's now more cushion for that bond to appreciate in value and to soak up more losses that would occur in your equity portfolio. So from a just nothing more than a risk management perspective, what we're seeing today, probably the best thing that we've seen in 20 years. So if you identify that, hey, I need to be rebalancing, I would highly encourage you to do it. And then the last point I will make also just kind of popped in my head just now is I like the point that you said, hey, if you're only like 2 or 3% over, is it really worth it to rebalance? And I would say the answer to that is no. And the reason being is that, again, you talked about it's not a free lunch. You're going to have to pay taxes. And so when you kind of say net, what did I really get out of this? It's marginal. The rule of thumb has always been if it's 5% or more, do it.
Yeah. Yeah.
And it's kind of the same thing. Think about it when you try to refinance your mortgage payment. You know, every time that interest rates go down, you don't immediately, pick up the phone, call your banker and say, refinance my mortgage.
That's a great,
Because there's costs associated with it. There's a certain amount it needs to go down before it makes sense.
and a certain amount of time that you expect to live in that.
Exactly.
Yeah.
And so the same is true with portfolio management. And so, I would say the 5% rule is kind of the rule of thumb that, hey, if it's above that, go for it.
Awesome. Well, Chris, thanks for joining us today.
Absolutely. I
Really appreciate the insight. If you have any questions or if you want to discuss these matters further, please reach out to us at First Financial Wealth Management. Thank you for joining us today.
Absolutely. Thank you, Brooks.
Thank you.